Hey, good evening. Welcome back to another episode of Be Inspired Podcast, where we're inspiring you to live the abundant life you deserve. I got another awesome guest on the line. His name is Fadi. He's the founder of Legacy Wealth Builder Academy, passionate educator, responsible options investing. He's a coach, a professor, and he specializes in helping busy professionals, self-employed individuals, and high achievers build wealth. So, Fadi, welcome to the podcast, man. How are you doing tonight?
I'm doing great. Happy to be here, Samuel.
Awesome, awesome. So I want to jump right into it, but before we do, I just want to give a quick shout out to Creative Dream Collective. They do all our flyers, they do all our marketing. So a shout out to them. If you need any logos or anything, make sure you go ahead and let them know. They're gonna be linked towards the bottom. All right. So here we go. Patty, how did you come up with the master of your? What are some books that you recommend reading to get into the options investing?
I think the first book that I read a long time ago, like 30 years ago, that really helped me change some of my outlook is The Cash Flow Quadrant by Robert Kiyosaki. It's a very nice read, very easy read, part of the series of the books Rich Dad, Poor Dad, and basically tells people that there are four different ways to make money. My issue was I had a good job. I always got good grades. Had a good job, high paying job, but I was never wealthy. And I was preoccupied with the idea of wealth and how to create wealth. So I read this book and told me there are four different ways of making money. One is the employee, where everybody is groomed to be pushed into that category. And it's basically the worst deal. You're trading your time to make money to somebody else. There's the self-employed, carpenter in his shop, mechanic in his shop, doctor in his clinic. They're still swapping time for money, but they have a little bit of freedom, a little bit more tax advantages. So it's a better deal, and they feel a bit more freedom.
Yeah.
But both of these, if they don't go to the work, they don't get paid. The right side of the quadrant, very quickly, there's the business owner, which is think of somebody who has 50 Tim Hortons or 50 Starbucks. This person does not need to go to work every day. If they didn't go to work every day, the money would still flow in because he has managers, he has people who hires the employees. Basically, he's swapping other people's time for money. And the best is the investor who is trading other people's time and money to make money himself. Rich Dad, Poor Dad, The Intelligent Investor. Some nice books.
Awesome. Yeah, I think Cash Flow Quadrant is a good book to get into the mindset of business and help you
Yes.
understand the difference between employee and business owners. So that's a great book to start, especially the Rich Dad Poor Dad as well. You can start
Yeah.
there, you know?
Yeah, and it's very nice read. Like it's not academic. It's a very nice read. It's easy to understand, logical, and it makes sense.
Okay. All right. So, Fadi, I know you do stocks and you're in the stock market. So, tell us a little bit about the stock market and what should we look out for if somebody wants to get into it?
So investing after I read the book, investing for me was real estate and stocks. So I started with real estate and I was under the impression, or I totally believed that anybody who invests in stocks is a gambler, is somebody who is not responsible because everybody around me was losing money. And then 15 years ago, I went to this course and my eyes were opened and I understood few things that I didn't understand before. So some of the things I'm going to share with the audience here is, um, stock market, there's a lot of money to be made in the stock market, but the issue is that there's some myths and people don't understand how it works. Same as if you have a dog or a python, these are two different pets. The reason I'm saying that because in one of my rentals, somebody came and said, I have a pet, a python. So dog will eat every day. Python will eat once a month. The dog will bite very differently than a python. The danger of both, the risk of both is different. The python kills in a very different way. So you need to understand the animal. So the stock market's a lot of myths. Number one, the first myth is that people think they can make money quickly. And that's a killer because if you think you can make money quickly, you will be duped or scammed into stuff that will make you lose your money very quickly. Okay. So it's not a get rich quick scheme. And I hate day trading. I talk to a lot of people, Samuel, and so many people lose money because of they buy into this illusion, this lure of I can make money very quickly and I'm going to bet on something and tomorrow it will be double the price. Reality is a lot of people lose a lot of money in day trading. It's not a consistent way. So making money slowly or responsibly, patiently is the theme. you need to understand that I want to think of Warren Buffett. He made tremendous ROI, 6 million in ROI, but he made it in 70 years. Okay. So that it takes a lot of time. I'm not saying that anybody needs to wait 70 years, but the outlook, you always need to look at long-term view, not short-term. Because the stats say that if you leave your money in the market, stock market, the longer the time, the lower the probability of losing money. So think of a graph that goes like this. The higher the number of years you leave it in the market, if you leave it for 20 years, the probability of losing money is 0. If you leave it for 10 years, the probability of losing money is about 5%. If you leave it for 1 year, the probability of losing money is 25%. Meaning the more long-term view you have, the better for you. Okay. That's not number two. People think, that's a big myth out there, that the stock market has to go up in a straight line. So as soon as they buy something and it goes down a little bit, they completely panic. Or it goes up a little bit and then in 1 year it goes down, they panic. The stock market breathes. It's very volatile, meaning it goes up and down, up and down, up and down. Overall, the average is about 10 to 11% per year. But it doesn't go in a straight line. It goes up and down. So it doesn't, like, I need oxygen, but it doesn't matter how much I need oxygen. If I inhale, there has to be a time whereby I have to exhale. It doesn't matter how much, it doesn't matter how much oxygen I need. The normal behavior is that I will inhale and exhale. So the stock market is the same. There's absolutely nothing wrong with the market going down, correcting every now and then. We have the statistics. Out of every 5 units of time, 4 units of time is going to go up or sideways, and one unit of time is going to go down. Overall, it's going up by 11%, but it goes up, 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 and then down. Up, 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 and then down. It goes up slowly, goes down quickly, but still only 1 unit of time out of 5. So understanding that the stock market goes up and down is completely normal. There is nothing to panic about. Okay. Third, you need to focus on really good stocks. You need to understand what is a good stock and focus on good stocks, because good stocks, basically we are buying companies. We're not buying lottery tickets. If the way you look at the market or go into the market and your mentality is buying lottery tickets, that it works, you're going to lose money. You're buying businesses. And if you spend 3 hours, if you want to buy a refrigerator, people spend 3 hours researching what is a good refrigerator, which is the reliability, what is the reviews. If you buy a car, you spend a lot of time. So if you're buying a business, like if you're buying a piece of Apple, you need to know if Apple is a good company or not. If you're buying, most people, the extent of the research is just their friend told them, listen, buy this stock, it's good. Or they find a stock that went up for a little bit and they think it's going to go up forever. So you need to evaluate it like a business, meaning you need to look at it, see if it's making money, because the objective of any business is that it's creating value and creating money. There's no business that I can label good and it's losing money. It's not in my book. So only 1% of the stock market is investable in terms of the companies that are there. So you need to search and need to understand and learn what is a good company. Only focus on good companies, because one of the things you need to understand as well, if you're going to invest in the stock market, is there is absolutely no correlation between price and value. Meaning a good stock, the price of a good stock can be going down, 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 down in the short term. And short term means 2 years. So a good stock can have its price go down for 1 year or 2. And a bad stock, the price can go up. So there's absolutely no correlation in the short term between the price and value. However, on the long term, meaning 5 years plus, there is 100% correlation. That's what Peter Lynch told us, great investor. There's 100% correlation between the price and value on the long term. Meaning if you have a good stock, it doesn't matter what happens in the short term, because in the short term, the prices are basically fueled by fear and greed and speculation. There's absolutely nothing rational about it. This price that goes up and down every day has no value at all for the responsible investor, for the investor who actually knows what they're doing. We look at long term, we focus on good stocks, and we wait, and it goes up. So Warren Buffett told us always that when he buys a stock, he actually hopes it goes down. The reason is, if you have a son, you don't weigh your son every day thinking he's going to grow every day, right?
Yeah.
If you buy a property, you don't ask the next day you buy it, did it go up or not? Like, it's a long term. It's a little bit of a marriage. You need to wait. So when Warren Buffett, his head is in the right spot. When he buys a stock, he buys it for the long term. So if you buy it for the long term, meaning he has absolutely no expectations that it's going to go up the next day. If this is your mentality, what would you want to do? You want the stock to go down so that you can buy more. So these are some of the things that people need to understand. What are they dealing with? Like,
But
if
what makes people what makes people approach the stock market as like a casino or lottery tickets? Because I know you mentioned that a little bit earlier. So
it's
what makes
greed,
them greed?
because psychology plays a big part of that, whether people are understand this or not. So fear and greed are two very strong emotions that we all have. If you're completely fearful, you will do nothing because the fear will paralyze you. You'll have no action. But if you're completely greedy, you will have no fear. You will do something stupid like selling your house and buying lottery tickets. So a lot of people are driven by greed in the stock market. They think they can make money very quickly. So they treat it as if it's a casino because nothing that you cannot make money very quickly in anything, right?
Yeah.
So you need to be, you're investing meaning you're putting money somewhere whereby you think it's going to grow up later in the future. And we do that by investing in businesses that produce value and profitable and gives a lot of value and sells a lot of product, make more revenue, make more profit, and it creates value as it goes because that's the objective of the business. Buying something today thinking it's going to go tomorrow is a sure way to lose money because it's not consistent. Let me ask you this question. Do you know any billionaire who is a day trader? Samuel, you know why not? Because it's not doable, because it's not consistent. Because if it's an easy way to make money, we would have seen some billionaires who are day traders by now, but there's none. The reason is like this should tell you that it's not doable.
So what's the difference between a trader and an investor then?
Okay, so I'm a trader too, but I have a investor mentality. That investor's time is long term. His outlook is long term. The trader sometimes is very small. The day trader, people, they buy and sell in a day. There's some people called scalpers. They go in and out in a few seconds, which is suicide, really. That's the first thing. Number two, investor um, seeks a long-term relationship with the stock. So they pick the stocks very carefully because they know that they're going to have this relationship with the stock for years and years and years because they are looking at long term. So it's very important for them to choose good quality stocks.
Yeah.
The trader on the other side don't care. They don't care if it's a good stock or not. All what they want is the volatility of the stock, that it goes up and down, hoping that they will catch the stock at a point whereby it's low. And then when it goes up, he will sell quickly and make money. So they don't care if the stock is good or bad. Another difference here is that, think of it this way. The investor is like somebody who's proposing to marry. Okay. They make a lot of research. For them, the quality of the stock or the quality of the spouse is very important. The trader is like a one night stand. They don't care about how good they just want to have fun for one night. So the trader is very erratic, very reactive. Investor is very patient, very calm. They don't care if the stock goes up or down in the short term because they have a long-term view. Like, let's say if you have a son and he's not behaving well, you're not gonna like you can have a relationship with your son for many, many, many years. So like, it doesn't matter if he's not behaving well in a day or two,
Yeah.
right? So it's very complete different mentality.
Okay. So how important is it to protect your financial future as an investor?
So the first objective is not, when you're investing, is not the highest ROI, which I know it's very weird for people to hear that. The first objective is to protect your capital. Meaning, if you go in with, I don't know, $1,000 or $10,000 or $10 million, your first objective is not to make the highest amount of money. The first objective is to protect your capital. Second is, with your capital a bit relatively safe, you try to get the highest ROI. If this priority is not clear or it's switched, people lose money. Because if you go in and your objective is to get the highest ROI, what will happen is that, think of it this way. If I want to go from Toronto to Florida, it takes about 24 hours of driving. If my objective is to reach Florida in 3 hours, Samuel, driving, what will I have to do to be true to my objective? If I have to reach Florida, if I want to reach 3 hours and I need to be there in 3 hours driving, so what will I have to do? Normally it's 24 hours.
Create a plan. You got to create a plan, the routes,
Okay, but
prepare.
I have the plan and the route, but it takes 24 hours. How will I get there in 3 hours? What will I have to do in terms of speed?
You have to fly. You can't drive.
No, I need to drive. I have to drive. I will drive, but I need to reach there in 3 hours. What will I have to do in terms of speed? terms of like the speed that I'm going to be driving at. I will have to drive at really high speed, like 900
Yeah.
kilometers per hour to reach there, right? So if I know how to drive, but if this is my objective, and if I'm driving at 600, 700, 800 kilometers per hour, it's just a matter of time before I get involved in an accident, correct?
Yeah.
So same thing. If in investing, you're targeting really high ROIs, ROI and risk that's another myth, that people think that they can get the ROI without the risk. The risk and ROI are the two faces of the same coin. They are coupled that cannot be separated. Meaning, if you're seeking really, really high ROI, it actually comes with high risk. Think of buying a lottery ticket. It has the highest ROI possible. You pay $1, you get $1 million in a lottery ticket. But also on the other side, if you look at the risk, most people, 99.9999% of people, when you buy a lottery ticket, they lost the money because nobody wins, right? Very few people win. So really high ROI means really high risk as well. So understanding that your objective is to protect your capital first, meaning you have to be looking at the risk and understand the risk of everything you do so that you do proper risk mitigation techniques. And I myself don't go for really, really high ROI trades or investments because I understand that really high ROI means really high risk and I don't want to take the risk. It's smart not to take the risk.
All right. So, all right, what is the success formula for being in the stock market?
So for me, there are few things. Number one, strategy. People think that if they go to YouTube and learn a strategy that
YouTube University.
they're there. Yeah. Basically, they got it. Strategy for me is about 10% of the equation. Okay. Because what you want is repeatable success, not just one time, right? It's, I want to make money this month, next month, and next year. So we need a strategy that actually works on the long term. I don't want the day trading short term because it never really works. So strategy is 10%. What is more important than strategy is risk mitigation, meaning you understand and fully study and understand how other people using the same strategy lost money. Okay. So same as in driving, most of learning how to drive is avoiding being in an accident. That's really like pushing the gas pedal and the car moving is nothing. That's not really driving. Any fool can do that, right? The whole skill of driving is how good are you in avoiding and not being involved in accidents. Okay. So 10% is strategy, 30% is risk mitigation, understanding how to not lose money. And then understand that 60% is psychology, dealing with the fear and greed. Again, everybody needs a little bit of a healthy dose of both, because if you're too fearful, you will do nothing. You will not invest. You're not going to make money. And if you're too greedy, you will invest in stupid stuff that will make you lose your money. So we all need a little bit of greed to push us to do something, a little bit of fear to make us aware of the risk. And if you have these three things, that's still not enough. Coming back to the example, if I refer back to the example of the driving from Toronto to Florida, if your objective is to double your money every year, you will for sure lose money because it's too much ROI, which means it comes with a lot of risk. So for me, my sweet spot is trying to target 24% per year, which is 2% per month. For me, that's really good because it's double the market and I can adjust my risks so that it's not that huge. And I use options to do that. So strategy, risk mitigation, psychology, and then having the right target is important. One last thing is that while you're learning, you need to learn in a way, like if you're learning how to drive, you don't take the car and go to the highway. That's not learning. That's too much risk. If you're learning how to swim, you don't jump into the North Sea, for example.
Yeah.
So in investing, what you need to do is to open something called a paper trading account. A paper trading account is a free account and everything in it is real. They give you $1 million for free to train. So there's zero risk of losing money. You don't make money, but you don't lose money. But everything is real. And you test your strategy and you test your risk mitigation. And only when you make money in paper trading account, then you can graduate to put your own money. For me, anybody who's starting, who just puts their money to try, that's not very irresponsible because you're still learning, right? So if you're learning how to swim, you need to go to a shallow end of the pool to learn how to swim, right? Like that is the normal thing to do. So for me, these are the 5 elements. Number 1, strategy. 2, risk mitigation. 3, dealing with your psychology, fear and greed. Having the right objective, which is for me 24%. And the last thing is dealing in a paper trading account. You have these elements and only you graduate yourself to use your real money once you prove the concept Because I tell people, if you don't make money in paper trading, you have no business going into, because it just means that whoever taught you doesn't know what they're doing, or you did not understand the strategy, or you're making mistakes. Regardless, you fix it in paper trading before you graduate. Okay. So I'll give you a couple examples, but before I do that, let's talk about the criteria, how to figure out what is a good company. A company has to be making money, right? So for me, BlackBerry, for example, is not, I worked for BlackBerry for 6 years. You know the BlackBerry phone? But they're not a good company for me because they have been losing money for a few years, for 4 or 5 years. So it's not a good company. A company has to be pumping net earnings or profits. Okay. So what I want in a company is that history, at least 5 years of good net income or earnings. And I want to see that trend is going up, really good revenue is going up, very strong balance sheet in terms of shareholder equity. And shareholder equity means basically what the company owns, assets minus liabilities. I want to also see that they have really good free cash flow statement. And cash flow is very important because if a company does not have cash flow, think of two companies. One has cash flow, one doesn't. The company that has cash flow can invest in R&D, can invest in the new products that they can sell later in a year or two, right? They can buy back stocks. They can give dividends. They can buy other companies. They can go into new technologies. They can expand in new different regions. Apple, for example, I don't know if you know, they spent $10 billion in a project that didn't work. They tried to do an electric vehicle. This shows how strong Apple is because they have so much money. They can afford to make an experiment or go into a business. They're trying to do a new product, which is the electric vehicle. I know it didn't work, but if they didn't have the money, like BlackBerry cannot afford to spend $10 billion on something because they don't have it. So very important free cash flow. Also very important that they have something called a strong moat, meaning it's not easy for other companies to come and steal your customers. So for example, Apple, I don't think they make the best phones. Samsung makes best phones. However, if my phone goes bad, I will not buy anything other than Apple. Why? Because it integrates with my iPad, with my EarPods. There's this cool factor. I'm also got used to it. So that's a strong moat when people are so attached. It's very hard for people who are on Facebook to leave Facebook. If you're in a company that uses, for example, SAP as your ERP system, Enterprise Resource Planning System, it's entrenched in the guts of every process. It's very hard to change it. If your company is using an accounting software, very hard to change it. So these are all strong moats that it's not very easy for people to change or somebody to come and steal your customer. I need all of that. So some of the good companies are Apple, Meta, Amazon, ING, Coca-Cola. All of these are good companies, basically. And you will be amazed. There's about 6,000 companies in the US stock market. Do you know how many of them on average, like rough number, how many are losing money? 10%, 20%, 30%, how much are losing money? Okay, it's 50. 50% are losing money. So I have this screener that just, I tell him, I just want all the companies with net earnings more than zero. And half the companies are thrown away. So here's the thing, if you just buy a stock because your friend told you, what are the chances? Like if you use the screener to remove the companies that are losing money and the companies that don't have good ROIC and the companies that don't have a good moat, if you remove all of that, you end up with 100 companies or something. So 100 companies out of 6,000 stocks. If you're randomly choosing stocks, what are the chances you're going to end up with a good stock? It's very small. So you need to have a vision in terms of the stocks you pick. So there's so many good brokers. I use IBKR, Interactive Brokers, but there's so many. I like IBKR because the fees are low. It's not very user friendly, but once you learn it, it's for me the best for me. But there's so many good ones as well. And what I do as well is that I have a 12-week mentorship program where I teach people, even if they don't have any experience. It's designed for busy professionals. So somebody who is risk averse, somebody who don't want to risk their money, because I don't have any appetite. Like my age, Samuel, I don't have any appetite to lose money at all. So I teach busy professionals how to make 24%. That's the target, 15 minutes a day. So once you learn the system, it's a 12-week mentorship program. It's very hands-on, basically to spend 15 minutes. And I love it because I know when I retire, when I'm I can do it when I'm 80 years old. I can do it when it doesn't need any physical effort. All what I need is a cell phone. So when I go with my kids to Disney, for example, I like to make a trade on Disney in Disney while I'm on the line, because it's so expensive, to recoup some of the money from Disney. I like it when I can make a trade in a beach in Egypt. Anywhere I go, all what you need is a cell phone and 10, 15 minutes a day. And it's a really, really great way to make money if you do it in a responsible way. If you can control your greed and fear, there's much money to be made. But it needs time. So you go at it very methodically, and with time, you can do great. Is it doable? Can the average person do it? And I'm here to tell you, absolutely you can. Your 9 to 5 will not get you to wealth. Any responsible person needs to be in these 3 categories if you're serious about making wealth: stocks, real estate, and owning a business. Owning a business is the hardest of all, because the chances of you making it there is very low, just by like 10% of it takes a lot of work. I started in real estate. It took me 15 years to basically go into another. So at some point in your career, in your life, you need to be in the 3. You start with stocks or real estate, not the 3, not the 2 at the same time. Focus on one, learn it very well, make money, stabilize it, and then go to the other. But the high net worth people in US or anywhere, 80% of their money are in these 3: stocks, real estate, business. We all started the employee. I'm out of my employee 9 to 5. I have my own business, and I'm in the 3. I do what I preach. You start an employee, don't resign tomorrow. Wait, you have to learn. So this is what I did for many, many years. In the morning, I used to go to the 9 to 5. And as you know, 9 to 5s are not really 9 to 5. It's 9 to 5 and you take work at home and you're on call and all this stuff. But at my own time, I used to study investing, but took a lot of time to dial real estate. And here's the thing, you need to take responsibilities. My father wasn't a big investor or a very rich guy. So you need to take the responsibility. Stop whining. You need to take the responsibility, and you'll be making mistakes. That's okay. You make mistakes and you stand up again. So it's absolutely doable. Choose stocks or real estate. Go learn. There are 3 levels of learning. The free YouTube stuff. Everybody starts there. Second, courses. And if you pay for a course, you will get the value. Third is mentorship. Most people, my statistics show that 3% of people who take courses end up implementing it. Okay. So 3 levels. Of course, as you go down, it's more expensive. So free, YouTube, or any other platform. Second is you pay for a course to get a bit more attention. Third is mentorship. So learn, apply, and if you're persistent, there's no way you will not be successful and making money. So this is a poem by William Ernest Helney. I have it as my desktop picture, and I love this poem. And it says, basically, the end of it: I'm the master of my fate. I'm the captain of my soul, or the captain of my ship. Basically, it reminds me that I am responsible. I am the one who will be creating whatever I need to create in my life. If I need happiness, I'm the master of my fate. I will create happiness. If I need to be wealthy, I want to be wealthy. Guess who's the captain of the ship? It's me, right? It also reminds me that I'm not a passenger on somebody else's ship. I'm the master. I'm the captain. It empowers me. It shows me that it's me. It's me. It's not going to happen except when I do it. So I would not be expecting anybody else to make me wealthy or make me happy or make me anything, because who's the master, Samuel? I'm the master. I'm the master of my ship. I am the captain of my soul. And I wholeheartedly believe that. And when I feel that I'm down, if you're the captain, if you're on a ship and the captain, because there's some wind, you see the captain on a corner crying. What kind of captain is that, right? So if you're the captain, it doesn't matter if it's windy or there's problems. You're the captain. You just pull yourself up and you're the captain of the ship. Do what you need to do. Even if the ship will go down, doesn't matter. You're the captain. Just pull yourself up, be courageous, do the best you can to the best of your ability as a captain. I love it. I'm the master of my fate. I'm the captain of my soul. I changed it. I made it the captain of my ship. Okay, nice. I'm on YouTube. My company name is Legacy Wealth Builder Academy, so that you can go to the website. I have a lot of master classes that are pretty affordable, very cheap, and lots of value. LegacyWealthBuilderAcademy.com. You can connect me on LinkedIn or Facebook or YouTube. Lots of stuff on YouTube as well.